What if you could buy the world's biggest ETFs from your phone, trade them 24/7, and settle in seconds? No stock exchange hours, no waiting. That's the promise of tokenized ETFs. But here's the catch, not all tokens are what they seem. Stick with me to the end because I'll give you a simple 5-step checklist to decide whether you should even touch them. First, let's cut through the jargon. Think of a traditional ETF like a concert ticket printed on paper. It gets you into the show, you know what seat you have, and the venue is regulated and well lit. A tokenized ETF is that same ticket turned into a QR code on your phone. In theory, it's the same show, but the way it's issued, traded, and checked at the door is different. And the rules can be very different too. There are two main flavors you'll run into. The first is a regulated fund that uses a blockchain for record keeping and transfers. In this model, the token represents a real share in an actual fund. You still have a professional manager, audited accounts, and a regulator looking over the shoulder. The second flavor is synthetic. Here, the token tries to mimic an ETF's price using a derivative contract. You're not a shareholder, you're a counterparty. Economically, it can move like the ETF, but in legal terms, it's closer to an IOU than a seat at the show. Why are serious institutions even bothering with tokenization? Because the plumbing of finance is old and slow. Central banks and global standard setters say tokenization could make settlement faster, reduce reconciliation, and cut some middlemen. Asset managers see the chance to issue shares that can move instantly between approved wallets, pay out income automatically, and plug into new platforms. You get the idea, less friction in the pipes. You can already see versions of this future. Franklin Templeton runs a US government money market fund whose shares live on-chain. One share equals one token with ownership recorded on a public ledger. BlackRock launched a tokenized liquidity fund on Ethereum for qualified investors investing in cash, US Treasury bills, and repos. These aren't gimmicks. They show that mainstream finance is experimenting carefully where regulation allows. Regulators are experimenting too. The UK has a fund tokenization blueprint. Hong Kong's securities regulator has issued guidance on tokenized securities and tokenized authorized products. In Europe, the MiCA regime is rolling out rules for crypto asset service providers. The direction of travel is clear. Explore the tech, protect investors, and don't break the system. Now, let's talk about accessibility, the big selling point. If you live in a market where US ETFs are hard to access, a token that tracks them looks like a magic key. Some platforms in Europe now offer round-the-clock stock tokens and ETF tokens that mirror US names. Sounds great. But read the fine print. Many of these are synthetic contracts. They can be priced off the ETF, but they don't give you voting rights, fund shareholder protections, or necessarily the same recourse if something goes wrong. It's like watching the concert through a live stream. You see the show, but you're not in the building. What about 24/7 trading? That's the headline feature. Traditional exchanges close, blockchains don't. You can trade at 3 a.m., but markets are interconnected. If the underlying ETF holds US stocks, accurate pricing depends on those stocks trading. Trade the token far away from market hours, and the on-chain price can drift from the off-chain reality. When the exchange opens, prices snap back. That can be a nasty wake-up call. Let's stack up the benefits. Global access, potentially faster settlement, programmable payouts, and the chance, down the line, for your holdings to plug into new financial apps. In some places, tokenization could open doors where the local financial system is expensive or unreliable. If you've ever waited days for a cross-border transfer to clear, instant settlement feels like magic. Now the trade-offs. First, investor protections. UCITS ETFs in Europe and similar structures elsewhere come with layers of safeguards, disclosure, independent oversight, and compensation schemes if a firm fails. Synthetic tokens don't usually come with that toolkit. Second, counterparty and platform risk. If you buy a synthetic token, you're relying on the issuer or exchange to make good on the contract. If the platform is hacked, mismanaged, or shuts down, your legal claim can be murky. Third, smart contract and custody risk. A bug in code or a compromised wallet can turn a sophisticated product into a very simple loss. Finally, liquidity. Token markets can be shallow. Wide spreads and slippage are real costs. Finally, regulation and tax. The token you hold might sit in a different legal bucket from an ETF. That means different disclosure, different protections, and possibly different tax treatment. So should regular investors care today? Here's the honest answer. Tokenization is probably part of the future of market plumbing. The biggest names are already testing it where it makes sense. Money funds, short-duration instruments, institutional workflows. But for most people building long-term wealth, plain vanilla ETFs remain the gold standard. Cheap, simple, regulated, and easy to own in a standard brokerage or pension account. If your goal is to match the market and sleep well, you don't need tokens to do that. Still curious? Here's the 5-step checklist I promised so you can decide with a cool head. 1. Identify the type. Are you buying a token that represents a real share in a regulated fund or a synthetic token that only mirrors price? If you can't answer in one sentence, stop. 2. Check the regulator and the wrapper. Is the fund authorized by a recognized regulator? If it's a platform token, is the platform licensed where you live and under what regime? In the EU, does the provider hold authorization under MiCA? In Hong Kong or the UK, does the product fall under the Tokenized Securities Guidance or a fund tokenization model? Write down the actual authorization, not just the logo on the website. 3. Verify how it's held and what you legally own. Where are the assets custodied? Who is the transfer agent? If it's on-chain, can you see the token contract and supply? If it's synthetic, what is the exact legal claim you have and against whom? Pretend the music stops tomorrow. Who owes you what and how do you get paid? 4. Manage trading and security risk. Use limit orders, not market orders, especially outside the underlying market's hours. Expect wider spreads at odd times. Turn on two-factor authentication. If self-custody is offered and you use it, learn key management before you move a cent. Back up your recovery phrase and keep it offline. 5. Size it like a science experiment. Start tiny, think in percent, not pounds or euros. Set an exit plan before you enter. If returns depend on features that sound like too good to be true, assume they are. Your retirement plan shouldn't hang on a pilot project. Here's a quick example to make this real. Imagine you want exposure to the S&P 500. Option A is a low-cost ETF in your regular brokerage account. You pay a few basis points, you're in a regulated wrapper, and you can hold it for decades. Option B is a token that tracks the S&P 500 via a derivative on a crypto platform. You can trade anytime, but you might face wider spreads, platform risk, and unclear tax treatment. If your purpose is long-term compounding, option A is boring, and that's the point. If your purpose is to learn the new rails with lunch money sizing, option B might teach you something. Just don't confuse a lab demo with a pension plan. One last metaphor. Tokenization is like building a high-speed rail line alongside an old road. The road works, it's proven. The rail line could be faster, cheaper, and better for everyone once the tracks are finished and the safety systems are certified. Today, some sections are open, mostly for freight, with strict supervision. You can ride them, but only if you understand the route and the rules. Most passengers are still better off taking the road. Just a heads up, nothing in this video is financial advice. It's all for information only. Explore more tips on money and investing at Money Nova's website. If this helped you, hit subscribe, because I'll be breaking down the next big shift in plain language. And remember, technology can change the rails of finance, but the rules of good investing don't change. Keep it simple, know what you own, and let time do the heavy lifting.